In this video, we're going to look at the two most popular types of oil and which one you should be focusing on if you're trading these markets. Hello, I'm David Jones from Capital.com. Now, we all know that oil is an incredibly important world commodity. It's also continues to be a very popular market with traders, but there are different types of oil you can trade. The two main types are Brent Crude and the US version, West Texas Intermediate. So which one should you be following? Why do traders like this? Let's get into it straight away. Let's start off by looking at the differences between these two markets, what drives the price, and then we'll jump on the charts to look at typical volatility. Let's find out a little bit more about the two most popular grades of oil when it comes to trading. So there's Brent crude oil, which we could refer to, I suppose, as the UK version, and then West Texas Intermediate, which is the oil produced in the US. There are some technical differences between these two types in quality and their makeup. Brent, for example, has the higher sulfur content. Brent pricing sets the standard for around 2/3 of world production. So I suppose if we were going to pick the slightly more important market here, this line here suggests that we should be leaning more towards Brent pricing, but when it comes to trading, it's completely up to you which one you trade. Whereas WTI, as its name suggests, West Texas Intermediate, produced in the US, so that is the benchmark for US crude oil production when it comes to pricing. Broadly speaking, WTI, the US version, is better for petrol production. Brent tends to be better for diesel fuel production. Historically and at the moment, Brent usually trades at a premium to WTI, so it tends to be priced slightly higher in the market than the West Texas Intermediate grade of oil. But they do tend to move in lockstep. You know, if we saw a 10% rally in the price of Brent, we'd expect to see the price of WTI move a similar amount. We're going to get into the charts in a minute and have a look at the typical volatility. Before we do that, let's just talk a little bit about what drives the price of both of these grades of oil. Clearly, oil is an incredibly important commodity, for the world economy. So the state of that global economy will have a major factor on fluctuations in the oil price. When the economy is booming, factories are at full capacity, churning out goods, they're getting shipped around the world. Clearly, there's a lot of demand for oil. So we'd expect the price to rise in the good times. If we saw a global recession or a drop-off in global growth, factory production, industrial production slows down, there's going to be less demand for oil. So that's a simple supply and demand equation. Less demand normally means the price would start to tail off. So the global economy and things like trade wars are a big factor when it comes to the price of oil. Then, of course, there's political uncertainty. You know, oil is produced in various regions around the world. If there is a war, for example, let's go back to the first Gulf War in the 1990s. You know, we saw the price of oil soar. So, you know, major instabilities such as that, or just general political uncertainty in a certain area, which could have an impact on supply, clearly is going to affect the price of oil. And it is all about supply as well. You know, for example, if we had OPEC, the cartel of oil producing countries in the Middle East, if they decide to either dial down the taps or increase supply, that's going to have a knock-on effect fairly quickly on the oil price. So factors like that are watched. You know, if there may be concerns that prices are slipping, then maybe they'll take a step back and try and reduce that supply to prop up the price. So all of these three sort of major factors can have massive impacts on what's going on with the oil price, both in the short term, but also over the longer term as well. For example, if we had a protracted economic slowdown, you'd expect the price of oil to have a significant downtrend. Let's get into the markets and look at these two grades of oil in a bit more detail. So let's start off by looking at Brent crude. So I've got the chart here going back about 6 months or so. We had lows for Brent crude late 2018, just ahead of $50 a barrel. Traded as low as $50.42. Then we saw a recovery up above 74. The price actually trading up to 74.73. And at the moment, at the time of recording, it's trading just above $60 a barrel. Let's have a look at WTI. US oil for a comparison. And over the same time period, here is the US WTI oil. You can see late 2018, traded as low as $42.33 a barrel, pushed as high in April up to $66.55, and it's currently trading at $52 a barrel. So it's around about $8 less than the UK Brent crude version. So there is that difference in the spread, but you can see that it moves, the price of oil moves, whichever grade we're looking at, moves in a similar fashion. So I've jumped back onto the Brent crude chart for now, just to show why traders like this market. It's the volatility. It's a major world commodity. Look at the move. October 2018, Brent crude trading up above $86 a barrel, and then we had that low in December, down around about 50. So that's a significant move. And then into 2018, a significant bounce back, recovering pretty much 50%. So a massive rally. So we see big swings over the medium to longer term, depending on what's going on with supply and the economy. But if we change this to a short-term chart and we look at just the last couple of days or so, again, we've seen Brent crude trade as high as 62.40 a barrel, and then slip below $60 a barrel. So again, more than $2 move over a couple of days, and it's this sort of volatility, short, medium, and long term, that means oil is likely to continue being a really popular market for short-term traders all around the world. When it comes to trading these markets, with Capital.com, it's really straightforward. Let's do something on Brent oil. Let's say we think that actually the sell-off has been overdone, down to 60. We want to put a stop loss the other side of these lows. Maybe our stop goes in at 59.60. Let's place the trade by pressing buy. We can choose how large or how small to trade. I'm going to trade the smallest I can here, 0.1, just as an example. I'm going to set my stop loss up. So I'm going to say a stop at 59.50. So I'm going to click close at a loss, and then just simply choose my price, put 59.50 in, and that's it. I'm ready to go. So I'm trading really small here. So my margin requirement is fairly tiny. It's only 47 pence on my account. I'm going to buy wherever the price is trading and close with a stop loss at 59.50. So once I'm ready, I click on buy and my trade is done. You can see there in the bottom left the confirmation, and that's it. I've bought oil. If I click on portfolio, there's an old trade in there from before, I think when we were doing a session on Uber, and there's my Brent crude oil buying at $60.46 a barrel. So it's as easy as that. And if I change my mind, I want to come out of the trade, click on close, and the trade will be closed. So Brent crude is arguably slightly more important of the two, but from a trading point of view, I don't think it makes that much difference. When we looked at those longer term moves, we can see they do tend to move, even though they're different prices, they do of course move in a similar way, and they are likely to remain incredibly popular with traders around the world, because they do reflect what's going on in the global economy. We'll wrap things up there, but to find out more about trading and crude oil, go to our website, Capital.com. To never miss out on updates about oil and other markets, indices and currencies, make sure you're subscribed. And if you click the notification bell, you get notified every time we upload new content to our channel. Good luck with your trading.